Hello and welcome to PWM. A trade war between the US and China has probably been the biggest fear for investors over the past several months. But President Trump's decision to extend trade talks and delay a planned increase in US tariffs on Chinese imports has given markets a big boost, particularly in Asia. But what can we expect for the future? To discuss these topics, I have with me Markus Stadlmann, Chief Investment Officer at Lloyds Bank Private Banking. Welcome, Markus. What's your take on the trade negotiations and how they are going to affect markets?
I think if we look at the impact that trade disputes have had, then we need to differentiate between economic impact and impact on investors via sentiment. And clearly, to start with investors, there's been a lot of nervousness on financial markets last year from when the trade disputes started at about July during the summer, and then going into the end of the year as well. And I would say that the rhetoric by the US administration has changed slightly since the midterm elections, but it's still been very much on investor minds to think about what the trade disputes might actually do in terms of damage to corporate profits mostly. Then there is economic data, and as far as we can see, the trade disputes don't show up at all in the data. And that's a surprising sort of consideration. Why is that the case? Mm-hmm. It is because if we think about trade between the two countries, the US and China, then obviously services and goods are in the frame in principle, but services are not affected at all by the trade dispute. So they're immediately out of the question. And then within the goods sort of area, the goods that are sort of included in the trade disputes between the two countries actually make up a relatively small percentage. Intermediate goods, which are much more important for the supply chains of global manufacturing, are not included at all. So this is why we think that we need to look at the detail to understand what the impact is. And for us, it was sort of an overhyped situation in the second half of last year. And Chinese equity prices, as you know, fell heavily on the back of those trade disputes. And so we saw this as an opportunity, as we didn't think the economic impact would be as substantial.
Asian equities actually emerged as the most attractive asset class in PWM's Global Asset Allocation Survey, which tracks the investment and asset allocation intentions for 2019 of more than 40 private banks, together managing $10 trillion in client assets globally. So do you agree with this view?
Absolutely. So coming back to China one more time, we felt that Chinese equities were heavily oversold at the end of last year. So we increased our capital employed in the country. We invested more money in Chinese equities, and there were two reasons. One reason was this situation of being oversold, but the other reason is that the representation of the Chinese equity market in global emerging market indices is in the process of going up, right? This is because China has become more and more important over the last couple of years, and there are also various sectors in the Chinese equity market. And one of them had been excluded from most emerging markets indices, at least to a substantial degree, and that was the Chinese A-share market. So that market is now starting to be reflected. Some providers have actually decided to do that in a stepwise fashion. So we know that the weight of Chinese equities in the emerging markets equity asset class is going up from about 25 to 40%. So independent of what's going on in the trade disputes and economically in the country, there's also a strategic re-rating by index providers. So both of those together formed a fantastic case, and I think to some extent still sort of are a fantastic case. I mean, Chinese equities have risen strongly since the beginning of the year, which has helped us and our investors. At the same time, I think there's still some room to recover because Chinese equities fell by 30% last year.
And within A-shares in particular, do you see that there are specific types of equities that are likely to benefit from fiscal stimulus or from Chinese growth?
Within Asia, there's quite a heavy weighting or concentration of financial services stocks, right? More than in other Chinese equity indices. So what's going on in financials is most important or more important looking at Asia's. And monetary policy has become more stimulative at the end of the year as well. So Chinese authorities turned around and made a couple of changes that were positive for banks and other financial services providers. So definitely the future looks brighter for banks and insurance companies listed in China. And, this is within the wider Chinese market. This is one opportunity set. But one has to be very, very selective. You can't just buy, a sector or even the country, we think, outright. You have to be very, very selective within the country and within the sector to pick those companies that are likely to win over the long term, rather than invest with those that are going to have difficulties.
And finally, Markus, what's your outlook for tech companies in China in particular?
It's another interesting sector. So technology companies have grown generally in importance in emerging markets investing over the last 10 years. If you go back to the financial crisis, technology stocks in global emerging markets indices were about 10%, 10-12%. They have now grown to be about 30% of the emerging markets world. And sort of several large technology companies come from China, but there are also a number of medium-sized and even smaller technology companies that trade in China. And I think this is a very, very interesting sector. In some areas, Chinese companies are actually leading technology developments. I think this is definitely one sector you don't want to miss as an investor.
Okay, probably this is also an issue with the US, this supremacy of tech companies.
I think one interesting theme behind the trade disputes, which are a lot about particular goods and about tariffs, is the issue of property rights and intellectual property in particular, right? So China has been very sloppy, let's say, in allowing foreign companies to protect their intellectual property in China. And that's been a big issue behind the scenes. But they are unlikely to be resolved the way the current trade process. It's not really a negotiation. It's more a process driven by the USTR, by the US Trade Representative. But I think they need a finer comb and actually need to enter into negotiation to resolve the issue of intellectual property, which I think is definitely a topic that I would be grateful for the US to pick up on. It's not as prominent. Obviously, we've seen the issues around Huawei in the US, but that's just one company, right? This is a very, very broad theme, and picking on one company is not necessarily tactically very, very efficient.
Thank you very much, Markus, for joining me.
Thank you.